Imagine it is a completely ordinary Tuesday afternoon. You go to check your mailbox just like you do every day, and there it is, a letter from the Internal Revenue Service. Your stomach drops, your hands go cold. You stand right there on the front porch and your mind immediately goes to the worst possible place. Am I being audited? Did I do something wrong? How much is this going to cost me? You go inside, set the envelope on the kitchen table, and stare at it for 10 minutes before you can bring yourself to open it. Sound familiar? Because for millions of retired Americans in 2026, that exact moment is happening more often than at any point in recent memory, and the overwhelming majority of them had absolutely no idea it was coming. My name is Whitfield, and on this channel, we exist for one purpose: to make sure that you understand the rules of the financial systems that affect your retirement before those systems catch you off guard. If you are watching for the first time, hit that subscribe button right now. Every week we cover the things that protect your income, your savings, and your peace of mind. And today's topic is one that touches more retirees than almost anything else we have discussed on this channel. So subscribe, stay with me, and let us talk about why IRS letters are landing in so many mailboxes in 2026, and exactly what you can do to make sure yours is not one of them. Let me start with a number that I think will genuinely surprise you. The IRS sends approximately 170 million notices to individual taxpayers every single year. That is not a typo. 170 million. That is more notices than there are people in most countries on Earth. And within that enormous number, a very significant portion go to retired Americans, people on fixed incomes who are not running businesses, not earning wages, and who genuinely believe their tax situations are simple and clean. The reason so many retirees are receiving IRS letters in 2026 is not because retirees are doing something dishonest. It is because retirement income is more complicated than most people realize, and the IRS's computer systems are more thorough than ever before at catching discrepancies between what was reported to them and what appeared on your tax return. Here is how the system works at its core, and this is important to understand because it explains everything that follows. Every year, hundreds of different companies, banks, financial institutions, and government agencies send documents directly to the IRS. Your brokerage sends a form showing your dividend and interest income. Your IRA custodian sends a form showing your distributions. The Social Security Administration sends a form showing your benefit payments. If you received any payments through a digital payment platform, that platform sends a form. If you sold a stock or a fund, your broker sends a form. All of these forms arrive at the IRS, and the IRS's computer system, called the Automated Underreporter system, takes every single one of them and checks them against the income, deductions, and credits you reported on your tax return. This process happens automatically. There is no human being sitting down and reviewing your return by hand at this stage. It is software comparing numbers. And when the numbers do not match, when something was reported to the IRS by a third party but does not appear on your return or appears in a different amount, a flag is generated and a notice goes out. That notice most commonly takes the form of what the IRS calls a CP-2000. The CP-2000 is the single most common IRS letter that retirees receive. And I want to spend a moment making sure you understand exactly what it is, because the misconception most people have about it is the thing that causes the most damage. A CP-2000 is not an audit. It is not a bill. It is not a criminal accusation. It is a proposal. The IRS is saying, we received information from a third party that does not match what your return shows, and we are proposing an adjustment. That is all it is at this stage. You have the right to agree with that proposal, to partially agree, or to completely disagree with documentation to back up your position. The IRS will not finalize anything or assess any additional tax until after you have had the chance to respond. The problem, and this is where retirees get hurt, is that the CP-2000 includes a response deadline, and that deadline is not flexible. You have 30 days from the date printed on the notice to respond. Not 30 days from when you received it, 30 days from the date on the letter. And since mail delivery can take a week or more, your actual window to respond may be as short as 20 to 23 days by the time the letter reaches your door. If you do not respond by that deadline, the IRS moves forward with its proposed adjustment automatically, and what was a proposal becomes an assessment, meaning you now legally owe that money, plus interest and possibly a 20% accuracy penalty on top of it. So why are so many retirees triggering these notices in the first place? Let me walk you through the most common reasons, and as I go through each one, I want you to genuinely think about your own situation, because most of these happen to good, careful, honest people who simply were not aware of a rule. The first and most common reason is unreported income from investment accounts. If you have a brokerage account, even a small one, that generates dividends, interest, or capital gains during the year, every single one of those amounts is reported to the IRS on a 1099 form. Your bank does the same thing with interest earned in savings accounts. And while the amounts can sometimes seem small, $20 here, $45 there, the IRS's matching system does not have a minimum threshold for what it considers a discrepancy. Even a small amount of investment income that does not appear on your return can trigger a CP 2000. For retirees who have multiple accounts, maybe a savings account, a small brokerage account, an old CD that matured during the year, keeping track of every 1099 and making sure each one appears correctly on the return is genuinely easy to miss, especially if you are preparing your own taxes without professional help. The solution is straightforward. Before you file any return, or before your tax preparer files on your behalf, request your wage and income transcript from the IRS. This is a free document available through your IRS online account at irs.gov, and it shows every information return filed under your Social Security number for that tax year. Comparing this against your tax return before it is filed is the single most effective way to prevent a CP 2000. The second reason is missed or incorrectly reported required minimum distributions from retirement accounts. If you are 73 years old or older, federal law requires you to take a minimum distribution from your traditional IRA, your 401k, or most other tax-deferred retirement accounts each year. This rule exists because those accounts were funded with pre-tax dollars, and the government wants to collect taxes on that money during your lifetime. The amount you are required to take is calculated based on your account balance at the end of the prior year and a life expectancy factor published by the IRS. If you do not take the full required minimum distribution in a given year, the penalty is significant, 25% of the amount you should have taken but did not. That is not a small number. And beyond the penalty, when your IRA custodian reports the full distribution amount on a Form 1099-R, which they are required to do, and your return shows something different, the IRS's matching system flags the discrepancy immediately. For retirees who have multiple retirement accounts who changed custodians during the year, or who did a partial rollover and are unsure how it should be classified, these mismatches happen more often than you might expect. Working with a tax professional each year that you are required to take distributions is genuinely worth the cost for the accuracy alone. The third reason specifically affects retirees who receive Social Security benefits, and this one surprises people more than almost anything else. Many retirees believe that Social Security income is not taxable, and for some people, at some income levels, it is not. But for many retirees, particularly those who also have pension income, IRA distributions, or investment income, up to 85% of their Social Security benefit can be subject to federal income tax. The threshold is based on what the IRS calls your combined income, which is your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefit. If that combined number exceeds $25,000 for a single filer, or $32,000 for a married couple filing jointly, a portion of your Social Security becomes taxable. The Social Security Administration reports the full amount of your annual benefit to the IRS on a Form SSA 1099, which goes out every January for the prior year. When retirees either do not report their Social Security income at all, or report it in the wrong amount, or fail to account for the taxable portion correctly, the IRS's computer system sees the SSA 1099 amount and compares it to the return. If it does not line up, a notice gets generated. This is one of the most preventable triggers of IRS letters for retirees, and the fix is simply making sure whoever prepares your taxes fully understands all of your income sources. The fourth reason is one that might seem almost too simple. math errors, transposed numbers, and basic data entry mistakes. But the IRS data book consistently shows that simple computational errors are among the leading causes of IRS correspondence to individual taxpayers every year. Entering a 1099 amount of $950 as $9,500, accidentally omitting a digit from a Social Security number, reporting an IRA distribution as a Roth conversion when it was not, putting income on the wrong line of the return. These are not acts of deception, they are human mistakes. But the IRS's computer system does not know the difference between an honest mistake and an intentional omission. It sees a number that does not match what was reported to it by a third party, and it sends a letter. The best protection against this category of errors is e-filing rather than paper filing whenever possible, because e-filing systems have built-in checks that catch many common errors before the return is ever submitted. Now let me tell you about someone named Robert. Robert is 69 years old, a retired school administrator from Tennessee. He has a small brokerage account he set up years ago that generates modest dividends, usually somewhere between $300 and $500 a year in various stock dividends. He receives Social Security, he has a small pension, and every year he does his own taxes using a software program he bought at the grocery store. A couple of years ago, Robert went through a difficult stretch. His wife had a health scare that consumed several months of their attention and energy, and tax season came and went in the middle of all of it. He filed his return, and he thought he had everything in order. But one of the smaller brokerage accounts, one he almost never checks because it barely generates any income, had sent a 1099-DIV that he had not received. He never entered those dividends on his return. The amount was $112. $112. And roughly 11 months after he filed, a CP-2000 arrived in his mailbox proposing an adjustment for that $112, along with interest calculated from the original due date of his return, and a 20% accuracy penalty on the additional tax. What had started as a $112 oversight became a correspondence that took Robert 3 months to fully resolve, caused him significant stress during an already difficult period of his life, and cost him more in time and anxiety than the original amount could ever have justified. Robert's situation is not unusual. It is, in fact, one of the most common patterns that generates IRS correspondence for retirees every single year. So let us talk about what you actually do if one of these letters arrives. The most important thing, the absolute most important thing, is that you do not ignore it. An IRS notice sitting in a pile of unopened mail is the most expensive thing in that pile. Open it the same day it arrives. Read it carefully. Find the date on the notice and immediately count forward 30 days from that date. That is your deadline. Everything else follows from that. Next, pull out all of your records for the tax year the notice is about. Your return, your 1099s, your W-2s, any relevant financial statements. The CP-2000 will clearly state which specific income item or items created the discrepancy. Compare what the IRS says it received from a third party against what appears on your return. In many cases, you will be able to see immediately whether the IRS is correct or whether there is an explanation. If the IRS is correct and you did miss an income item, the right move is to complete the response form included with the notice, agree with the adjustment, and arrange to pay the additional amount, either in full or through an installment agreement if the amount is significant. If you believe the IRS is incorrect, for example, if the income they flagged was reported on your return but on a different line, or if it was part of a rollover that was not actually taxable, then you have every right to disagree, and you should do so in writing with copies of the supporting documents that prove your position. Send your response by certified mail so you have proof of delivery, and keep copies of everything. If the amount the IRS is proposing is significant, or if you are not completely sure how to respond, this is the moment to call a qualified tax professional, an enrolled agent, a CPA, or a tax attorney who handles IRS correspondence. The cost of professional help at this stage is almost always far less than the cost of handling it incorrectly. And if you need more time to gather your documentation, you can call the number on the notice and request an extension before the deadline passes. The IRS will generally grant a short extension for CP-2000 responses when the request is made before the deadline and the taxpayer is engaging in good faith. Here is something I want you to take away from this video that goes beyond just knowing what to do when a letter arrives. The best response to an IRS letter is preventing it in the first place. And the single most effective prevention strategy available to every retiree watching this right now is this. Before you file your taxes for any given year, log into your IRS online account at irs.gov and pull your wage and income transcript for that year. This transcript shows you every information return, every 1099, every W-2, every SSA 1099 that was reported to the IRS under your Social Security number. Compare that list to the income you are about to report on your return. If everything that is on the transcript is also on your return, your chances of receiving a CP 2000 drop dramatically. It takes 15 minutes, it is completely free, and it is one of the most powerful things you can do to protect your retirement from unnecessary IRS contact. The second prevention strategy is equally simple. Make sure every tax preparer or software program you use knows about every source of income you have, no matter how small. The $10 in interest your savings account earned, the $200 dividend from a fund you forgot you owned, the small Social Security cost of living adjustment that pushed your benefits slightly higher than the year before. All of it matters because the IRS sees all of it. And any gap between what they see and what appears on your return is a potential notice. I want to close this video by saying something directly to anyone watching who has already received a letter from the IRS and has been sitting on it, maybe for a few days, maybe longer, because they are not sure what to do, or they are hoping it will somehow go away on its own. It will not go away, and the longer you wait, the fewer options you have, and the more it will likely cost you. But here's what I also want you to know. The IRS is not your enemy. They are an agency doing a job, and when taxpayers engage with them, when they respond, when they explain, when they ask for time, the IRS is generally far more reasonable than the fear that surrounds them would suggest. What the IRS is not equipped to handle is silence. Silence turns a proposal into an assessment. Silence turns a letter into a levy. Engagement is always the right answer. If this video gave you something you did not know before today, or if it helped clarify something that has been sitting in the back of your mind, I want to ask you one thing. Share this with someone in your life who is retired or getting close to retirement. Not because there is anything to be afraid of, but because the people who know how this works are the ones who never have to deal with it the hard way. One share from you today could genuinely protect someone you care about from a stressful and expensive experience. And drop a comment below. Have you ever received an IRS letter? What type was it and how did you handle it? Your experience could be exactly what someone else in this community needs to read right now. So tell me your story. I read every single comment on this channel and your answer genuinely matters. The next video coming on this channel is going into Social Security, specifically the mistakes that are quietly shrinking monthly benefits for retirees right now in ways most people would never catch on their own. If you are not subscribed yet, hit that button now so you do not miss it. Take care of yourself, protect your retirement, and I will see you in the next one.